So I decided to look into financial models after losing my lunch money on some meme stock options. Turns out a bunch of math guys have been trying to figure out how to price this stuff for decades. It all starts with this one famous equation called Black-Scholes, which, spoiler alert, is kind of wrong.
All right, so here's the plan. First, we'll talk about the one formula everyone knows, the one that got a Nobel Prize, so you know it's probably useless in the real world. Then we'll see exactly how it's useless. After that, we'll look at the even more complicated formulas people made to fix the first one, which are probably also a little bit wrong. And finally, we'll see how people use these kinda wrong formulas to pretend they know what they're doing.
Okay, let's get into it. Part 1, the so-called perfect formula. So the big problem in finance and life is trying to guess the future, which is, impossible. But that doesn't stop people from trying to slap a price tag on it. It's basically just sophisticated gambling, but with enough Greek letters to make it look smart. And these bets are called options. An option is basically a ticket to a party you might not want to go to. It gives you the right to buy a stock at a certain price. If the stock goes up, great. You use your ticket and make some money. If it tanks, you just throw the ticket away and pretend you were never interested. The whole game is figuring out how much to pay for that ticket up front. So, back in the 70s, a few guys with enormous brains came up with a formula to price these things. It was called the Black-Scholes model, and everyone loved it because it was a simple, clean answer to a messy question. They even got a Nobel Prize for it, which is usually how you know it's about to be proven wrong by reality. The formula itself is pretty straightforward. You just plug in the stock price, the price you want to buy it at, how much time you have, all the easy stuff. But then there's this one tricky little variable called volatility. It's basically a measure of how much the market is freaking out. And the model's big, beautiful, and completely wrong assumption is that the market's freakout level is always constant. Like a Zen garden. Yeah, right. And that one tiny detail, that whole constant volatility thing, that's where it all falls apart. So, section 2, when the nerd's perfect little model met the real world and got punched in the face. Yeah, so Black-Scholes thinks the market is some calm, predictable robot that moves smoothly. But anyone who has ever seen a stock chart knows it's more like a toddler on espresso. It's not predictable. It's just chaos with a ticker symbol. So you have these traders, right? They know the formula is broken, but their bosses want them to use it. So they came up with a genius workaround. Some guy put it perfectly. They were using the wrong number in the wrong formula to get the right price. They started working backwards. They'd look at the real price of an option in the market and force the formula to tell them what the volatility should be. Now here's the test. If the model was actually correct, if volatility was really this one constant number, then the answer you get from working backwards should be the same for every single option on a stock. It should just be a flat, boring line.
But, of course, it's not a flat line, not even close. When you actually plot it out, you get this weird U-shape that quants call the volatility smile, which is ironic because it's basically the market smiling at how dumb your model is. It's proof that traders are pricing in way more fear of a crash for those extreme options than the happy little Black-Scholes world accounts for. So yeah, volatility is not constant. Shocking, I know.
So the volatility smile showed everyone the model was broken, and the academics, instead of giving up and getting real jobs, just decided to make more complicated models. The market was basically telling them their model was a fairy tale. It doesn't account for things like, massive global crises or some CEO tweeting a weird meme. So the quants had to go back to the drawing board and try to staple more reality onto their broken theory. So this is a classic expectation versus reality situation. The Black-Scholes world on the left, everything's fine. Prices move like a gentle river. The real world on the right, things are on fire, volatility is having a panic attack, and prices can just, teleport downwards without warning. And this led to two new flavors of complicated math. First, you've got jump diffusion models. That's a fancy way of saying sometimes stuff just suddenly crashes. Then you have stochastic volatility models, which is an even fancier way of saying we have no idea what volatility is going to do, so let's just say it's random too. Progress. Okay, final section. Why any of this actually matters. Because if you're like me, you're probably wondering why we can't just go back to guessing. Well, it's because banks use this math to not lose billions of dollars, or at least to try not to. See, when a big bank sells you an option, they're now on the other side of your bet. They don't like risk, because risk means they might have to pay for their third yacht with their own money. So they do something called hedging, which is basically making a bunch of other bets to cancel out their first bet. The main way they do this is called delta hedging. Delta is just another Greek letter that tells you how screwed you are if the stock moves a dollar. So if the delta is, say, 0.5, you go out and buy half a share of the stock to balance things out. The goal is to be delta neutral, which means you've engineered your portfolio to not care if the stock wiggles a little. You're perfectly balanced for about 5 seconds.
Because, of course, that perfect balance only lasts a moment. As soon as the stock price moves, the delta changes, and now you're not balanced anymore. So you have to run out and buy or sell more stock over and over. It's a full-time job of just frantically trying to stay still while everything around you is moving. Sounds fun, right?
And here's the real kicker. Black-Scholes assumes you can do this rebalancing thing infinitely, like some kind of trading god. But in reality, the market can just jump. It opens 20% lower, and there was no in-between price where you could have adjusted your hedge. And just like that, your perfectly safe position blew up. That's why those jump models matter. They're basically an admission that sometimes you're just going to get wrecked. So the big takeaway is that these better, more complicated models mean banks are slightly less likely to accidentally blow up the entire global economy, which is, probably a good thing. It helps them manage their risk a little better, which is supposed to keep the whole house of cards standing. Which leads to the big philosophical question at the end that I'm contractually obligated to ask. We keep building more complex models to predict what is fundamentally a bunch of unpredictable humans and robots buying and selling stuff based on fear and greed. So, can a math formula ever really figure all that out? Probably not. But people will keep getting paid a lot of money to try.